When credit markets start to break, it's a major warning sign for stocks and the economy. I'm Steve Van Metre. Are stocks about to crash, or is this merely a warning? Now, let's head over to Bloomberg, where we picked today's story up on the headline. U.S. credit risk gauge shows fear rising as tariffs loom this week. But is this just about the tariffs, or is there something structurally wrong with the U.S. economy that the credit markets are worried about? Because when credit markets start to break, well, it means the stock market is soon to follow. We're going to find out, is this just a warning, or should we watch out because chaos is about to roil the markets? The spread on the market CDX North American Investment Grade Index, which rises as perceived credit risk climbs, jumped this morning to the highest on a roll-adjusted basis since August of 2024. And this is a sign of risk off as investors look to move their money. Interest rates drop, and that means the price of investment-grade bonds rise. But look at what's happening in the junk bond market. Talk about a major warning sign. The junk CDX index, which falls, meaning interest rates rise as credit risk increases, now hit the lowest on a roll-adjusted basis since August. So at the same time investors are seeking safety, they're also seeking a larger premium for their risk. And this is a big problem because when economies slow down, this means that for companies that have a lot of debt, in particular faced with refinancing that debt, it means their cost is going up. And right now, a large number of companies are going to have to refinance this year. They're going to face higher yields at a time when the U.S. economy is slowing. But will the tariffs push us into a recession? Is this the cliff that the credit market's warning about? Let's take a deeper look. Because we had an eventful weekend with a slew of headlines from Washington. Wall Street Journal suggested that the 20% tariff hike across the board is now back on the table. Remember, the markets weren't expecting that. They thought that Trump was going to dial back the tariffs a bit here. Now, all of a sudden, there's fear this is going to be a 20% across the board, along with his comments that he couldn't care less if automakers raise prices due to new tariffs. Geopolitical tensions were also on the rise with Russia, as Trump said that he may put secondary tariffs on oil and Iran. In addition, there was a concerning article on AI spending slowdown from the information. So what we're seeing from the markets that all of a sudden is being hit with bad news. And you start to think back to Friday, and what did we see from the University of Michigan? Well, the sentiment survey showed that consumer confidence was plunging. And there's a strong relationship between consumer confidence and the economy, not to mention the stock market as well. So what we're seeing here in the credit markets is perhaps just a strong warning that if we continue down the path of the tariffs, that it could be all-out chaos. The problem is we might be there already. It's all about the tariff uncertainties. As from a strategist at Jefferies, the negative scenario for the market would be that April 2nd just marks the starting point of negotiation, and that we have an extended period of negotiations where there's not much clarity on the tariff structure. So we can see what the credit markets are starting to worry about is demand is plunging due to massive amounts of uncertainty due to the tariffs. And if this continues for an extended period of time, what it means is a lot of companies may not be able to pay on their debt. And that means at a time where we're already seeing delinquencies in the consumer space on the rise, what is threatening is that business delinquencies will start to head up. And that means after a certain point, delinquencies turn into defaults. And next thing you know, asset prices and stocks come crashing down. And let's take a look at the evidence as we turn to this chart where we have the delinquency rate on credit cards in blue, on consumer loans in red, and then business loans in green. And you can see going back to 1994, delinquencies started to rise in the consumer space, but it did not impact businesses right away. As delinquencies stayed relatively elevated during the mid-90s, what happened? It eventually hit businesses as slowdown started to impact their finances. Next thing you know, business delinquencies on the rise right into the dot-com bubble. Let's take a look at what happened going into the global financial crisis, because in late 2005, consumer delinquencies started to rise. And again, just like it happened in the 90s, it did not impact business delinquencies until it hit all at once. Next thing you know, all three surging higher right into the financial crisis. And look where we're at now. We see delinquencies rising in the consumer space, but business delinquencies still remain relatively low. And that is what the credit markets are warning about, is that delinquency rates across the business sector could surge higher. When that happens, it's a foregone conclusion. When consumers are in delinquency and businesses are in delinquency, it means we're right into a recession. And Goldman's constant slashes S&P 500 target again on growth risk. And now we're starting to see headlines that people aren't just worried about inflation, they're now concerned concerned about growth at a time. We've looked at the U.S. economy and we can see that it's massively over indebted, not just in the consumer space, but on businesses as well. So now what we're seeing again in the credit markets is interest rates on high yield debt are going up. Businesses are going to have to absorb that higher cost to service their debt, and what that means for the economy, more particularly the U.S. labor market, is a massive red flag. But just because the credit markets are flashing red doesn't mean your trading account has to go down. Let's take a look at this trade back on March 10th on Brazilian equities. Our subscribers were stopped out for a 7% gain in just under 2 weeks. And we're already on to some of our next big trades because we're seeing some massive dislocations in machine positioning, which is creating big opportunities for their trading account. And you too can join in. Stay tuned to the end of the show or hit those links in the description and grab that coupon code for your free 30-day free trial. Because if the growth outlook and investor confidence deteriorate even further, valuations could decline much more than we forecast. Because if you think about valuations of equity prices, it's everything to do with growth and consumption expectations. So if all of a sudden demand in the U.S. economy is plunging, well, that means stocks look to be overvalued and would then have to come down in a hard correction, perhaps even further down than they're already at now. And we continue to recommend investors watch for an improvement in the growth outlook, more asymmetry in market pricing, or depressed positioning before trying to trade a market bottom. What Goldman's suggesting is that stocks could come down even further. And it starts to make sense of why the credit markets are flashing red, because what they're telling us is the risk of default in the business sector are rising and rising at a rapid rate to the point where if credit spreads blow out to the upside, what it means is chaos is going to hit the markets and much harder than most people expect. And let's take a look at the role of consumer and sentiment against the markets, why we're seeing markets move down despite people buying the dip aggressively, and it's everything to do with sentiment. Let's go back to the late 1980s into the 91 recession, and we see the University of Michigan Consumer Sentiment Survey in blue, and what happened? Sentiment came plunging straight down, and when consumers lose confidence in the economy, it means they're spending less, businesses, and make less money, and next thing you know, right into that 91 recession. We can look and see the same relationship happen going in the dot-com bubble. You see the NASDAQ was peaking here at the same time. Consumer confidence was falling off a cliff, and next thing you know, stocks went nosediving right along with that. We look what happened coming out of the pandemic. There was a big drop in confidence, and that's what impacted the markets. But then confidence went rallying higher, and despite the fact the evidence the U.S. economy was slowing, stocks rallied with it. Now, what are we starting to see? Consumers losing confidence, and they're afraid, not just about their jobs and their income, but they're afraid that we could head into an all-out recession. And this is what's driving people out of the equity market right now. But at the same time, people are buying the dip because they believe that something's going to change very quickly. Now, the issue is, if the tariffs go away very quickly, meaning this gets resolved, yes, you could absolutely see a market rally here. You could see confidence go up. But the risk now is, if this extends for a long period of time, and it could be just a matter of weeks, what you could see is the U.S. economy plunge face first right into recession, and stocks will go right with it. The warning sign the credit markets are telling us right now. The market's focus is rapidly shifting to an outlook where recession is suddenly a possibility again. And again, we talk about what these high yield spreads are telling us is that this is a real issue. It's saying, look, the economy's running out of money here. Consumers aren't spending. They're about to lose their job. And for businesses, they've got too much debt. They have too much expense to service that debt. They're going to have to lay people off. And then that may not even be enough to keep them out of delinquency. You start to understand why the credit markets are very important here. And this is fueling a retrenchment from risk and appetite for the safest assets ahead of Trump's so-called Liberation Day, when he plans to announce a series of reciprocal tariffs against trading partners. Now, I want to know from you, are you excited about Liberation Day? Are you worried it's going to cause chaos in the markets? Weigh in the comments below. I'd love to hear from you, because this is upsetting. It's scary. It's exhausting. There's so much uncertainty on tariffs, and everyone is pessimistic about what all this means for the economy, corporate profits, which you see is impacting the stock market, and what I've been warning about, unemployment. And so the issue here is that when businesses face uncertainty, they freeze, because a lot of businesses plan well in advance, months and years ahead. But with tariff uncertainty and no idea how soon they're going to be over, or what the limits are, or if it's going to change even after they're done, it's causing major problems in the business sector. You start to understand why credit spreads are surging here, particularly on junk, because the more uncertainty that hits the economy, the less likely businesses are going to pay on their debt. And that's exactly what the credit markets are saying. saying is that we could be heading all out into a financial crisis. And the risk now we talked about yesterday is Friday, as U.S. monthly jobs report is looming. Estimates say it should come in between 135 and 151,000 for February. Remember, Bank of America said if this happens, it validates a soft landing and everything's good. But if it comes in underneath 100,000, well, it would tell us that the U.S. economy is headed into recession. But where is this likely to come in? Well, for right now, what we expect, it will hit that sweet spot, but it won't last much longer because there's going to be a payback period this economy is going to experience. And this all happens when you pull forward demand, which we did during the pandemic, and then we pull forward again going into the tariffs. At some point, you've got too much inventory, not enough demand, and that means you don't need that many workers. Let's turn to what's going on in Texas, as we now have the Texas Manufacturing Outlook, where we get some perspective on what's going on in the economy right now, and more particularly the labor market and what businesses are seeing. Texas factory activity rose in March after declining in February, which could be a sign that the U.S. economy is turning around. But what we believe, it's absolutely everything to do with the fact that people are front-running tariffs, and the evidence in the report validates that. Other measures of manufacturing activity were mixed. The new orders index moved up 3 points to a 0. A reading suggests demand in March was similar to February. Capacity utilization remained negative, but pushed up 6 points. Shipments index was positive as people looked to get things out the door. So what we're not seeing here is a big surge in new orders. What we're seeing is there was an increase, but it didn't come at the expense of rising capacity. Now, this is an issue for the labor market in particular, because this is a warning sign that workers should be paying attention to. When these junk spreads rise, well, it's a big warning for businesses all across the country. It means they're going to have to cut jobs, and what we're seeing in the Dallas Manufacturing Survey is jobs are likely to get cut in the months to come. Let's take a look at the relation between capacity utilization and the unemployment rate. Unemployment rate in red, and what do we see? A near mirror relationship. So as the percentage of a factory that's being utilized to produce goods goes down, well, the need for employees goes with it. You see people hitting the unemployment line. And you see this happen in each and every cycle, in particular going into recessions. So what is the likely effect of all these tariffs? Well, when you pull forward demand, it means going forward, you don't need as many goods because you've got to sell all the stuff you produce. And that's what the Dallas Fed survey is suggesting here, is the new order book just went back to 0. It really didn't go up, suggesting there isn't a lot of demand and maybe too much inventory. And what we see is the credit market telling us a firm warning that if we continue down this path, we're likely headed into an all-out recession. Let's take a look at the labor market measures, because it suggested a decrease in headcounts and slightly shorter work weeks this month. So just as I suggested, we're going to see further weakness in the labor market as capacity utilization goes down. Well, employers do not need as many workers, and they don't need as many hours for those workers they do have. What we're seeing now in the report, that the employment index in Dallas slipped further into negative territory. At the same time, input cost pressures edged higher in March. And here's a big one, while wages, again, this is for people who still have their job, and selling prices remain stable. So what we're seeing is prices going up on the input side. This means businesses are going to take a hit at the margin unless they pass that through on the output side. At the same time, those who do have a job, well, they're finding out they're not getting pay raises, they're not benefiting from this. Meanwhile, their coworkers are losing their job and everybody's losing hours. And let's look at the details. What do we see inside the report? Words of uncertainty repeatedly showing up as businesses are worried. They don't know what to do. They don't know how to react here. And when that happens, spending gets cut and jobs get cut as well. Let's take a look at the details of the report. What do we see? Production index increased in March, but look at capacity utilization. Again, that went down. New orders, minus 0.1, so effectively unchanged from the month before. Growth rate or expectation of orders, minus 8.1. So if you think about being a business and you're already facing uncertainty and you're not seeing your new order book or your expectations that your order book's going to grow, what are you going to do? Again, you're going to lay people off once all of these orders are filled. You see unfilled orders, that went down. Inventories are up as people are front running the tariffs. And again, we talk about warning signs here of rising inventory levels, because a lot of people said, look, there's no way we can get deflation. But when you pull forward so much demand and you don't have people that can buy it, because again, what do we see in Dallas? Workers are not getting wage increases here, but the expectation is price of goods are going up. When that happens, inventory levels start to build, they start to stagnate. At some point, you have to cut prices. Talk about disinflation coming, maybe even deflation in the future. Want to know what you think? Weigh in the comments. Do you think that's on the table, or do you think these prices hold? Look at the employment and hours worked index, both down, and the uncertainty index on the rise. But let's talk about new orders here, because when we overlay capacity utilization, it's a sign that new orders are going down. And when we overlay durable goods new orders in red, what do we see? As new orders decelerate, well, that impacts the factory, capacity utilization drops, and next thing you know, the need for employees goes with it. And so again, you see what the credit markets are warning about is that businesses aren't going to be able to pay on their debt, because what the expectation from the credit markets is that new orders are going to go down, utilization is going to go down, profits are going to go down, and next thing you know, the risk of default is going to surge. See that happen again in 2014 through 2016. We see it happen during the pandemic, and now we're facing it again. What we're likely seeing is a little bit of Goldilocks scenario in the data that's causing the new order book and demand to go up. But right now, the expectation is once all this is filled, once all the demand is pushed through the factory, after that expectations for new orders plunging minus 8.1, telling us future demand going down, and that means there's going to be a major payback period coming for the U.S. economy, one that the credit markets are warning about. Let's take a look at retailer inventories against new orders. Let's talk about the disinflation and deflationary potential coming for the U.S. economy, because when you have a period of rising inventories, you see that in blue, all of a sudden what happens if demand goes down, which typically happens going into recession, you see new orders start to slow down, and until the inventory levels are brought back in line, you don't see new order growth head higher. We see this relationship happening during the global financial crisis, where we got outright deflation. We see it happen going into the pandemic, when we were facing a globally synchronized recession. And now look at this, inventory levels sky high, demand likely to head down. That means the new order book's going to dry up and quick, and along with that, the need for workers. And this is why we saw in the Dallas Fed report they're cutting hours, because when they cut hours, well, that means paychecks shrink, and when paychecks shrink, well, demand for goods goes down, and you can see the cycle building here. Let's take a look at average weekly hours of production of non-supervisory employees, this in red, against the new order book in blue. And what do we see? As hours go down, new order demand goes down, and you can see them virtually in sync in every cycle at every point. Now what we're seeing is employers being forced to cut hours due to uncertainty. What that means is demand from workers is going to go down as their paychecks go down, and you're going to see a self-fulfilling cycle plunging us right into a recession. It's exactly what the credit markets are warning about right now. And let's tie this all back to retail sales. We're going to look at real or inflation adjusted in blue against the consumer sentiment survey from the University of Michigan in red. And what do you see? As confidence goes down, because of course people are worried about their incomes and their jobs, their spending goes down at a time. What is the issue we're facing at a retail level? Inventory levels way too high. You see it happen going into the global financial crisis, and now you see the risks of why the market's reacting the way it is. You see stocks responding to a lack of confidence, but more importantly, it's the blowout in high yield spreads. Credit market telling us if we continue down the path we're on, a recession is not just an assumption, it's likely to happen. And based on all the other evidence, we could be in a full-blown financial crisis. But just because that happens doesn't mean you have to lose a ton of money in the markets. Let's take a look at that trade on Brazilian equities, because our CTA Timer Pro report absolutely nailed this one back on the 10th. Less than 2 weeks later, when markets were melting down, our subscribers locked in a nice 7% gain. Now, how do they do that? How do they know when to sell? Well, we let our stop loss or risk control levels guide us. But let's take a look at the report, because right now machine positioning is looking already on the downside in a big way. We could see even more selling, and this is going to create a huge opportunity. How do we do this? We look at machine positioning across the broad equity, bond, currency, and commodity markets, but we run a historical overlay to understand how the machines should be positioned, and then we can compare it to how they're actually positioned. So we find out dislocations when machines need to be buyers here, and that shows right up on our hot list each and every day. But what we're also looking for is any opportunity where machines have to be buyers. And again, we publish all of the data to our subscribers each and every day. But here's the best part. Just because we see a signal doesn't mean you should trade it, because in addition to getting the report, well, I review each and every recommendation the report puts out and tell you what I think the best trades are. So you get all of the signals, you get risk control levels, you get a full tracking of all of our open trades, plus a weekly update, disclosure on how I trade my reports, and here's the best part. Again, a 30-day free trial. Don't find yourself obliterated in this market when you can make money trading it. Again, hit the links links in the description below. Grab the coupon code for a free 30-day free trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.